Welcome to Looking at the Markets with David Modell. I've got a very special guest and a frequent guest. He is Mr. Lior Gantz. He is from Wealth Research Group, which is at wealthresearchgroup.com, which I highly recommend everybody watching and listening to this check out. The link is in the description of the video. You can just go ahead and click on that. So, Lior, welcome back to Looking at the Markets.
Thank you, David.
Yeah, it's always great to have you here. I learn so much, and my audience loves to have you here every single time. So, look, Lior, absolutely. Lior, I've been a reader of the Wealth Research Group since inception. Now, 2016 was definitely your best year in terms of the resource sector. I personally took profits on 12 different companies that you mentioned and covered that year for over 200% average gains. And 2017 was definitely your year for cryptocurrencies. I think I'll most remember that you covered Ethereum at $12, and it gained over 90 times that price. I bet people who even put $1,000 in there are absolutely delighted by the life-changing gains. Now, are there any opportunities
if they held?
If they held on to it, which you recommended, are there any opportunities such as 2016's resource rally or 2017's cryptomania? Are there any opportunities like those that you're seeing in 2018?
Well, in 2016, what happened was, if you remember, in December, 15th of December 2015, the Fed raised rates for the first time. And the day after that, I was inspired to start Wealth Research Group. It took about a month or 2 months to conceptualize the idea thoroughly. And at the end of January 2016, we actually launched. And the S&P 500 started correcting badly. And in order to hedge the correction, many hedge funds went into mining companies. And what happened was also the Central Bank of Switzerland and the Central Bank of Norway bought mining shares. And it was just a phenomenal year to be invested in mining shares very early. Around August, the bullish percent index for the mining sector, it reached 100 and stayed there for a while. And that was like the end of that 8-month period where mining companies were actually outperforming both the spot price of the commodities and anything else in the markets. So it was an incredible 8-month period. In retrospect, it is, if you look at a long enough chart of the resource sector, it is definitely an anomaly. It's not a bull market. It's sort of a hedging or a covering of shorts done by all these hedge funds that were long the S&P 500 and short mining shares that they had to do. Now, they've obviously corrected this problem, and they're not as short as before. So we're not seeing mining companies as cheap as at the end of 2015, but they are incredibly cheap again. Now, something that is cheap can remain cheap for a long time, and that is the key to understanding how to position right now in the resource sector. I'll give you an example. Since early 2017. You can find opportunities that are incredibly cheap in the research sector, but if you're not hedged, in other words, if you're not shorting a basket of ETFs that are going short the mining sector, it's hardly worth your time to position this cheap with quality names if you don't have a 2 to 4 to even 6 year timeline. Because the resource sector, which was very hot in 2016 because of short coverings, needs to have a real fundamental case in order to see sustained growth, a bull market, which it's not seeing. So the best thing you can do right now is to, if you have a long enough time frame in mind, a 2 to 4 to 6, 7 year time frame, is to position with the quality names right now because they're absolutely cheap. The insiders of companies are funding the projects at higher levels than the open market. In other words, people writing the biggest checks into these companies to fund their growth, to fund their drilling programs, to fund their the development, the permitting, all of this, and they have to they lock their shares in for months and years. They're paying bigger prices than the open market. So it's an incredibly cheap opportunity, but it doesn't mean that it's going to revert to the mean tomorrow. It does mean that it's going to revert to the mean at some point. So the trick is to take a position size that you're going to invest. Let's say you're going to invest 30 grand into a company, and you split that into 4 or 5 different occasions, and you just buy lumps instead of one foul swoop, because you don't know if you found that bottom. Resource companies are notorious for going down 50% even after they went down 50%. So it's just important to understand your idea or your strategy is to split your position size into 5 or 6 different occasions, and to short at the same time a basket of these mining companies that are hurting. So we're definitely not going to see a resource mania in 2018 as we've seen in 2016. We are waiting for the fundamentals to kick in. Now you're already seeing spot prices going up. So gold, which should always be your biggest position if you're going long commodities, is up 35% since it bottomed in 2015, since Wealth Research started. So it is in a bull market in the fact that the spot price is going higher, but the mining companies still not have the fundamentals to make an eruption, and the reason is mostly because they are not finding ore bodies. They're drilling and spending enormous sums, $50 and $60 billion in the last decade, to find fewer and fewer discoveries. And so that, I know what you're saying, that is very bad results, and that is true. Now the flip side to that is that the ore bodies of the large caps, the Barrick, the Newmonts, the Gold Corps, are depleting, and they have no way of finding new ones. So what they will need to do is start making acquisitions and look for companies that have pre-production projects that are trading for very low valuations right now and buy them out. Now, an acquisition spree is always what makes the fundamental case for miners better, because companies are going to buy them for much higher multiples than what they're trading for, because a large cap company must change replace their depleting assets. They cannot risk having falling production for long, because the shareholders will absolutely go bored and sell them off, and that is not something that the management can take lightly. So once you see the large cap companies starting to make acquisitions, that is the best time to position if you're looking for a trade, if you're looking for a quick 20, 30, 40% gain, and not for your mega 300 to 400% gains, which is what I'm in it for, which is why I'm waiting for several years if it happens. Now 2017, we saw the biggest speculative mania since the dot-com bubble. The trick was not to be right, because any cryptocurrency that you would have chosen had made substantial gains. Some of them have made better gains than others. The trick was just to be in instead of out. And so, as with anything else, the risk is increasing with the price. I know that Wall Street and academia and the efficient market theories, they have you believe that the beta, the risk that you're taking, is increasing as the price is dropping. So if something drops by 50%, it's riskier than before. But that is rubbish. That is bullshit. If you're looking to buy something, the cheaper you can buy it, the bigger your margin of error, the bigger your margin of safety. And so when we looked at Dash at $30 after I interviewed Amanda, or at Litecoin at $20 after I interviewed Charlie Lee, those were epic ideas because they were very cheap. Or Ethereum at $12 after I went to a convention and realized what a smart contract is. And our biggest winner was actually in Q4, and it was Ripple at 27 cents, and it went to $3 in a month. So that's an 1,100% gain in 1 month. We've had bigger winners in terms of Dash, went up 20 or 30 times, Ethereum 90 times, but not in 1 month. And the idea behind Ripple was that it was hated by the group of people that hate the banks. So Ripple was benefiting the banks. That's why people didn't like Ripple. But as a speculator, you have to go with a contrarian view. And that was what Ripple was, a contrarian play. In 2018, I do not see, obviously, something as big as cryptocurrencies were in 2017, because that was the biggest speculative bubble since the NASDAQ boom in the late 90s. It just doesn't happen every year. But what we are seeing are opportunities in some sectors. One of the sectors that we're looking at is anything that has to do with millennials that are changing consumer habits. It can be cannabis, and it can be what we call performance drinks. So, I told you off the air, I was an early shareholder in Monster Beverages that got sold to Coca-Cola. And now we're looking at other companies that are revolutionizing those segments of the economy, organic foods, anything that has to do with filling the gap for millennials. And one of the biggest things that millennials are going to be after, and not only millennials in the US, but I'm talking millennials in China, millennials in India, millennials in the booming new economies, they're all very much involved with the idea that they have, even as the power of one being, the power to change the outcome for our planet. So they're very much environmental friendly. And they view previous generations as over-consuming and I would say even tarnishing the planet. That is a very sustained view by the millennials, and therefore they're very much into electric vehicles. Now, as you see right now, the price of oil is heading higher, and governments around the world, France, England, India, China, the US, all around the planet, gasoline-powered cars are on an existential threat. Volvo is planning to go all electric. Ford is rolling out about 20 models that are going to be electric. Well, we all know Tesla, even though I made a lot of money shorting that company. But manufacturers around the world are understanding that the future is electric. And what we're seeing right now with Wealth Research Group is a huge trading opportunity. So not a 4 to 5 year plan or a 6-year plan, but a trading opportunity with a company called Wealth Minerals, which just hit its 52-week low Friday. So we're doing this interview Saturday morning. Yesterday it closed at $1.08 Canadian, and that is after it was already trading above 250. Now this company is very unique, it's just amazing to see what happened to it. So as you know, Mr. Market can go berserk and sell companies off at good news, which is what happened with Wealth Minerals. I talked to you off the air about this. Chile is the lowest producing lithium country in the world, and they produce much. If you go through all the major lithium production countries, like Chile, like Argentina, that triangle in South America, and then you look at Australia. Chile is like it's like the Saudi Arabia for lithium. Now you cannot export lithium out of Chile without a special government agreement. In other words, if you don't have that agreement, you can find the biggest mother lode ever, but you're just going to sit on it. And therefore, companies in Chile have to deal with the government. Now, Wealth Minerals is one of only 2 companies that have obtained that agreement. They have an agreement with Enami, which is a government-approved company, and now they can export their lithium. Now, in a business like commodities, where everyone is basically doing the same thing, which is drilling and finding ore bodies and then selling the same products. It's not like you're selling a different commodity. You're selling the same thing. It's only the managerial skill, the alpha that is produced by brilliant management that gets you anywhere. That's why I'm a huge fan of Keith Neumeyer, and that's why I'm a huge fan of Amir Adani, and that's why I'm a huge fan of Henk van Helfen, who founded Wealth Minerals because the guy just get things done. And right now, it's a huge speculative opportunity with Wealth Minerals. Now, you might be saying, David, hey, the company used to trade at $2.50. Now it trades at $1.08. Should I take the lead from the market and think that this is a risky play? And I remind you that Warren Buffett says, and very smartly so, that the market is there to serve you and not to guide you. In other words, I've done my research on Wealth Minerals. I just got off the phone with the president yesterday, and with Hank Van Helfen, the founder, and I can tell you this: the insiders are currently funding the company at $1.10. It's the free market, in the open market is $1.08. This is a hugely speculative opportunity to see a major reversion to the mean. And I know that you understand what I'm talking about here. A reversion to the mean is a reversion back to normalized prices for Wealth Minerals. And I think that once they continue with their drilling program and that people realize how important the strategic alignment with Anami is, this is going to create a situation that is very, very favorable for shareholders who are willing to go in very early. And this is 52-week lows. I mean, the risk is much smaller than a month or 2 months ago for the same company. Nothing materially has changed. And if you want to look at the company vetted or approved research that we did, you go to wealthresearchgroup.com/Chile. So I'm very excited about that. That is my #1 idea for the month of May for sure.
Well, I'll be watching that very closely. I personally am a believer. I'm a huge believer in electric vehicles, and they require lithium. That is true. So I'll tell you what. I'll put a link in the description below this video for that. It's a free report. Is that correct?
Yeah.
Yeah. wealthresearchgroup.com/Chile, CHILE. I'll put that link in the description below this video. And
David, just to give you a general idea, we have done everything in our power to keep Wealth Research Group free, and we intend to do so as long as we can.
Yeah, and that's fantastic. All right, so I'll be checking out Wealth Minerals Group. And for people who are curious about the stock ticker, because they always ask me that after these videos, it is in Canada on the TSX, Toronto Stock Exchange. It is WML, that is the stock ticker. And in the United States, the stock ticker is WMLLF.
And the $1.08 that I referred to is on the Canadian side. So obviously in US dollars, it's even below that.
Right. Yeah, I've got WMLLF in the United States at around 85 cents. WML at $1.08 exactly on the Toronto Stock Exchange. But just as importantly, people should do their research, do their due diligence, and why not use the research that is contained in that report? So people should click on that link in the description below this video. Man, you covered so many topics. Cryptocurrencies, you know my audience loves that, and I love cryptos as well. We obviously know that the street was late to cryptomania, as you alluded to. A lot of people buying in late 2017. Most people got in around then, but I'll tell you what, for people who positioned themselves early, like when you made a call on Litecoin at $20, yeah, they made a lot of money. Even after the January smackdown, they're still up massively if they're still holding. Sure. Could you define how you look at risk in terms of your portfolio?
Oh, that's a great question. Many people look at risk at various ways. At investing, there are only 2 major risks. The first risk is what I call permanent loss. In other words, if you are investing in companies that may never come back, that is truly risky. So I'll give you an example. A company that is looking to develop a product that needs an FDA approval and doesn't achieve that milestone, that company may never come back because the idea behind the company and all of the money that was spent to develop that drug is gone. And it's up to the management to basically find a new product to go after, a new product to develop, to pursue, and raise money. It's essentially like developing a new company. If you involve yourself in those type of situations, you are risking permanent loss. Now, permanent loss is just money that is gone forever. And the idea behind it is that risk is not defined by having positions that are currently down. I'll give you an example. I took a position in a company called Brady Corp. It's a small company, a few $1 billion, that are relentless dividend raisers. I love them because they raise dividends all the time. They've been around forever. It's a small company, but it's been around for decades and decades. And I bought it around $30 per share. Then the company reported a bad quarter. The market sold off, and it sold off so bad it went to $20. It went down 33%. I called the company, I talked with management, and I realized that this is just a case of Wall Street overreacting. So I bought at 20 again, making my overall position, because I bought more 20 than 30, I made the average cost 22. The company is trading today at around 40. Now, what is the idea behind it? And obviously this is a bull market, so companies go up in price in general. But the idea, David, is that you can sit on a position that is losing for months and even for years, and it's not risky if the fundamentals are improving because you own a piece of a business. Brady Corp throughout that time have increased their bottom line, improved their margins, raised their dividends, bought back shares, and so the price was just not reflective of the improvement. And that is exactly what you're looking for with investments. By definition, a rising price of anything makes it more susceptible to a falling price. And the opposite is true. When something is going down in price and it's below its intrinsic value, the reversion to the mean is more likely than before. In other words, as long as something drops in price with regards to the underlying value and is improving the fundamentals, it's less risky than before. And it reminds me of Warren Buffett buying Washington Post in the early 70s, and he bought it for $80 million. And then people asked him, well, don't you think it's risky? So he said, well, because the newspaper business was suffering badly back then. So he said, to buy Washington Post at $80 million is far less risky than to buy it last year. And he commented to shareholders who were afraid. He said, if the price of Washington Post drops to $40 million, you deem that as even riskier, where I see it as a bigger bargain. And so it's just important to understand the biggest risk is permanent loss and not temporary losing positions. Because if you're not buying at the absolute bottom, or if you're not buying while it's in an uptrend, then the price of any position that you buy will likely have a situation where it's a falling knife. And I want to comment that a falling knife is not the right analogy. Obviously, everyone wants to buy the knife wants to pick up the knife when it's on the floor. But a falling knife is a bad analogy because a rising knife would be the same problem. You don't want to catch any knife in the air. So the better version of this is to catch dollars, okay? And when you can catch a dollar when it's going down, it's easier to pick them up because they're coming to you instead of them going up and away from you. So that is the way I think about risk, and that has helped me in the last 18 years outperform the market almost half of the time. Almost half of the years. So it's just important to understand how I look about and think about risk. The second thing that is risky is to look at opportunities with the wrong expectations. And it's very important to look at historical precedents and how sectors and industries react to news and how they're span out over the years. And so I'll give you an example. if you are interested in cyclical commodities, for example, you need to understand that it's not a buy and hold type environment, as opposed to a very non-cyclical sector, such as, for example, consumer goods, so or technology. When I bought Intel in 2009, it was around $15 per share. It's over 54 per share right now. And I believe that the price of Intel will never visit that $15 again. In other words, when there are meltdowns, the best thing to do is, first of all, buy into any company that usually does not spend a lot of time below its intrinsic value. There are many companies, David, that only every 4 to 5 years become great opportunities, and some they become good opportunities every 10 to 15 years, and it's because they're great investments and the market just doesn't want to sell them off if they don't have to. But margin calls made people sell off companies like Intel at valuations that are close to bankruptcy valuations. So what I want to tell you is that the next huge recession, be ready and be cashed up to take advantage of opportunities to buy the best businesses on the planet when everyone else is panicked for nothing.
Yep.
Because 2008 was not going to change the fact that people need chips, computer chips, that is.
Yep.
And it's just important to understand that is how I view risk. Risk is buying too high, not having the right expectations, and the risk of permanent loss. If you can avoid those three, then you'll be fine.
That's a great way of looking at it. All right, now you mentioned Warren Buffett. It looks like many people, including Warren Buffett, do not believe that interest rates can stay low for extended periods of time. How will normalizing interest rates change the investment strategies and the market consensus?
So interest rates are like a weight that determines how investors should feel about other investments. In other words, there's this benchmark that's called the treasury yield, and usually people go off of the 10-year. So they look at what they can yield from the 10-year because that's called the risk-free bond, though it's not risk-free, obviously, but the market likes to judge off of it. So if right now the 10-year bond is yielding 3%, so anything else is judged off of that. In other words, when the risk-free bond, the 10-year, is priced at, let's say, $1.5%, then making 5% with stocks is incredible because you're making 3 times the risk-free yield of bonds. So you're happy to make 5%. Now, if the risk-free bond doubled and now it's 3%, which is what it is as we're doing this interview, then investors are not that happy to make investments which can only make 5% in stocks. They want to make more. Now, if investors want to make more in stocks, what have we just discussed? The only way to make more is to buy it for cheaper. So they're not that excited to buy every dip or to buy stocks that are trading at high multiples. They're not as compromising as before. And therefore, rising rates make people more patient about buying stocks, and therefore sellers have to sell at lower prices in order to accommodate for the risk environment for investors. I hope that makes sense. The higher the interest rate on bonds, the lower people want to buy their shares. And therefore, as rates continue to rise, prices for stocks in general will go down. And everything else will be judged on that as well. So if people at very low interest rates would say, hey, gold is a great investment, then in higher interest rates, they will start thinking about, hey, maybe I shouldn't own gold. Maybe I should buy gold equities or gold stocks because that's where I can make more money. Gold is something that I make money on when cash is paying nothing, but right now cash is paying 3%. So we can see a situation where people shift their gold ETF positions into the gold equities because of rising rates. rising interest rates are simply a way of benchmarking everything else that you're doing. But in an environment where interest rates are rising and inflation is rising as well, the yield is eroded by the inflation rates, and therefore bonds in general are not a good idea when this happens. If you're looking for high yield, you're looking for something that doesn't suffer the risk of inflation as much. For example, Wealth Research Group wrote an extensive report at wealthresearchgroup.com/bonds that you can download, and it talks about how fixed income investors should be involved with MLPs and in REITs right now, and not in bonds, because in REITs and in MLPs, you're basically not only getting high yield, but you're also hedging yourself for inflation, because MLPs invest in pipelines and natural gas and oil, and REITs invest in real assets, which are real estate, condominiums, hospitals, government buildings, etc., mini storage units, all the type of real estate that as an individual you probably will not get a chance to get involved with. Plus, they're very liquid. So if you buy a house, it's a matter of a lot of paperwork, months of research, and then to sell it would be the same thing. When you buy a REIT, for example, you buy it now, you can sell it whenever you want. It's liquid. It's a stock, basically. So that is very interesting, and we will cover our top 3 REITs at Wealth Research Group in the newsletter in the month of May. We are preparing this right now, and these are very exciting opportunities, because REITs have been obviously disregarded for the duration of this bull market, because people have just bought technology stocks way more than real assets. So I hope that kind of answers your question.
Absolutely. And you did mention another report that is wealthresearchgroup.com/bonds, BONDS.
Yeah.
And I'll put that link in the description as well. I'm a big fan of the reports, as well as the newsletter at wealthresearchgroup.com. So people can also go to the homepage and take advantage of that research for sure. We talked about inflation. We talked about one thing that has tied into inflation for sure is oil. I remember about a year ago or a couple of years ago when oil prices were around $35 to $40. And Wealth Research Group covered Chevron as well as 2 other oil companies that are much smaller than Chevron. And the reasoning was that even though the so-called experts are telling us that oil prices were heading toward, I remember people saying that it was going to head toward the teens, toward even $10 a barrel during that panic. You, on the other hand, felt that fracking had maxed out its potential to lower the price of oil, and that oil prices were heading higher. And look who was right. Yeah, not the experts, but it was you and Wealth Research Group that made that call. I took your initial research on Chevron, and I did my own homework as well, and I bought it at around $100 per share. And as we're doing this interview right now, it's at $130 a share. And I already took profits on those 2 other oil plays that were mentioned at Wealth Research Group. So what's next in this environment for oil speculators?
First of all, Chevron was a great play, because the market really discounted it a lot, because they were funding their dividends with debt. So they were raising debt to fund their dividends. They cared about the shareholders. They didn't want to cut or hold their dividends, because they're a dividend aristocrat, which means that they have raised dividends for over 25 years straight. They didn't want to have that momentum checked or stopped. And so people thought that they could not stand it for a long time, and the shares even went all the way down to about 75. And I dollar cost average it, and it's at 130 today, and they haven't cut or stopped dividends. They kept on going, and they're shrinking their debt obligations, so it's much healthier than before. David, oil is not only a commodity, it's a political tool, and therefore there are many things involved with setting the price of oil. Now, I visited the fracking fields and I saw the amazing technology that precipitated this oil boom in the United States. And there's an oil resurgence in the United States. A lot of high-paying jobs. Drillers are making, actual drillers are making like $6,000 or $7,000 a month in salaries, and executives are making much more. It's a job boom. It's amazing for the United States to have such a vibrant oil economy, and I think it's important for the future of the country. As it pertains to portfolios, higher oil prices are one of the most important determining factors in how much inflation is going to be around. Now, I know the government has ruled out oil prices as part of their inflation basket, but for normal people like you and I, who are not as smart as these academics that think that food and oil is not important to the price of to the level of inflation, oil makes a lot of sense to us to be priced in the inflation basket. When you have to pay more at the pump, you can pay less for consumer goods. So higher oil prices make people do one of two things: either spend less or save more. And because they're seeing higher oil prices, so they drive less and they take less vacations, etc., and they save more. And that raises the savings rates in the United States. Or they consume more. In other words, they said to themselves that, hey, before this gets any worse, I'm going to make some purchases. And what I see happening right now is people are quitting their jobs. The only reason people are quitting their jobs in record numbers is because they can think that they find better jobs. So what you're seeing is America is booming, oil prices are rising, wages are rising, overtime is rising. The entire American economy is at overcapacity, low unemployment, and with China easing their credit requirements, we are going into this inflationary peak. Everything is going to push up to the top, and I think that this is going to be the first time since the 70s that inflation is going to be one of the most talked about subjects in the mainstream media. How do you prepare? Well, the first thing you can do is get involved with commodities. That's one thing that's important. To make people understand how much my exposure to commodities is, you can go to wealthresearchgroup.com/portfolio and download my asset allocation model for 2018. I usually don't have more than 15% involved with commodities, because if I'm wrong, then I want to stop my loss at about 50%. And that would mean that 7.5% of my portfolio would be wiped out, which is something I can live with. But people, if they take positions with commodities that are 100% of their portfolio, then losing 50% would actually mean losing 50% of what you have. So commodities are very exciting, but they should be dealt with very diligently. So it's important for me to make sure that people understand that the asset allocation throughout various sectors is much more important than if you're right or wrong over the long term. And then with the majority, you need to get involved with cash flowing properties or cash flowing assets that are able to meet inflation and battle with it. So if inflation doubles, there are many companies that have such strong brands and brand power that even if they transfer those costs to the consumer, they raise the price of their products, this will not deter their clients from buying their products. One example would be, for example, diapers. If the price of diapers from your company that you're buying diapers from goes up by $4 or $5, it doesn't usually means that you're going to switch to different companies. Same thing with other strong consumer products. So that's another thing we're going to focus on going forward at Wealth Research Group in the newsletter. So I think that is important to understand, David. But in general, inflation is risky to developed economies because it distorts the free market and it makes CEOs very reluctant to make moves because they don't know how to calibrate prices going forward for their materials, for wages. They don't know whether or not to hire or fire, and it just distorts the economy. So it's important to understand that inflation periods are very short. They're not lengthy, but they can create opportunities because the market gets frightened and it values things at very low rates or high rates. So just important to understand that you might see prices go up and prices go down for things, and you need to position accordingly.
I tend to agree that inflation is going to be the big story for the rest of 2018 and beyond. Now, you mentioned that people can actually get a peek at your portfolio at wealthresearchgroup.com/portfolio, and we'll put that link in the description below this video. Can you talk about,
Thank you.
Yeah, absolutely. Can you talk about some recent changes that, now you mentioned you're positioning yourself into commodities, but just generally, can you talk about recent changes you're making in your own portfolio?
Sure. So in 2018, it's very hard to find companies trading below their intrinsic value in the at the wealth stocks level. The wealth stocks are companies that are that have been able to outperform the indices, the S&P 500, NASDAQ, the Dow, for many, many years because they're outstanding businesses. And if you buy them cheap enough, you will also be making a one-click decision and outperform the index, which is the holy grail of investing, right? And we cover a few of these wealth stocks. If you go to our site and you click on the top menu, you'll see wealth stocks tab, and then you can look at some of them that we already featured. It's very hard, as I said, to find them trading below intrinsic value because institutions love them and individual investors love them because they are very reliable. Now, occasionally, there are fads, FADS, or trends that deem some of these companies as obsolete. And if you can find those times and be brave enough and wise enough to understand that the market is wrong and that there's nothing to be afraid of in the long term, you can buy them real cheap. That is what I've always done, basically, and this is what I'll continue to do. It's called value investing. It's basically finding companies that have value because of irrational behavior by the market. In other words, in 2009, 2010, I was able to buy properties in Florida. That's where you live, right?
Mm-hmm, sure is.
Okay, so I was able to buy properties in very good locations in Florida, priced for less than their construction value. So in other words, they were cheaper than what they cost to even build them. There was no profit or premium involved. Now you would say, why would somebody do that? Why would somebody sell those prices? And it's because of what happened in 2008, special circumstances. Now, you would think the general market, capitalism, competitive forces would wipe away those advantages, those arbitrages, but they don't. People make mistakes. Emotions are involved. People sell things not for fundamental reasons. For example, asset managers, they sometimes sell off positions because they don't want to have them appear in their portfolios at the end of quarters. So, for example, if a company had a very bad quarter, it could even get worse come the end of the quarter where institutions sell them off just because they don't want them in their portfolios because clients new clients would want to see better portfolio performance, right? So they would switch, for example, a company that trades at a 52-week low, like Kimberly-Clark, for example, with Netflix, just so they can show clients, hey, we were Netflix and not in Kimberly-Clark, or we don't like Kimberly-Clark anymore. Now that even creates a better opportunity for people who understand the fundamentals of Kimberly-Clark. For example, I'm giving you examples here. So in 2018, I think the market is not as excited as it was in 2017. People are not buying the dip. Institutions are waiting. There's lots of cash on the sidelines, and there are opportunities for the long term for investors who look 10 to 20 years ahead, and they compound their dividends. Can I talk about compounding dividends for a bit?
Absolutely.
Okay, so a CEO basically has 4 different options on what to do with profits. So the CEO works for whom? For the shareholders, the owner of a company, and he needs to do whatever is best for them. One thing he can do is take the profits and reinvest them in the business. If he sees growth opportunities for the business itself, new markets, new products, or anything that can expand the business, he should do that. The second thing he should do is look at mergers and acquisitions. Now, usually CEOs are very bad at that. So I would be very weary of companies that make a lot of acquisitions, because usually they're value destroying. Look at Microsoft buying Skype for $8 billion. The price of Skype today, if Microsoft wants to sell it, it will be probably less than $1 billion. And the list goes on and on. Corporate mergers are a net negative, so be weary of companies that do a lot of big acquisitions. The third thing they can do is look at their own price of the shares and buy back some of those shares. Now, people ask, why would you do that? If a company has 1 million shares outstanding and you own 10% of those, David, 10%, and the CEO starts buying up shares from the market, and now there's 900,000 shares, so he bought up 10% of the shares. You still have 100,000 shares of 900,000 shares. So essentially, now you own 11 point something percent of the business without committing a single dime to doing it. Instead of owning just 10% of this business, you own almost 12% of this business. So you own 20% more, and you didn't commit a single dime for that. Now, it's tax-free. So in other words, your gains will not be taxed. No one would, the IRS doesn't come to you and say, hey, you just made 20% gain here. You own 20% more of the company. So when companies buy back their own shares, they increase your overall position in the company tax-free. Now, when do you want to do that? Obviously, when the same as yourself. So if you are buying companies because they're trading below intrinsic value, the CEO should notice the same thing and perhaps buy shares of their own company. So that's why companies do that. And the last thing they can do is pay out a dividend. And a dividend is just a straight cash distribution to the owners of the company. Why would companies do that? It's if they see that there are not any better uses for shareholder money. And therefore, the best companies are able the best CEOs and the best companies are able to have enough funds to do all 4 activities if they make sense, and still increase the dividends and the buybacks every year. So if you find companies that have enough profits to raise their dividends and buy back shares all the time because they're not expensive, so the market is not hyping them up, those are the best investment over the years. And you can look at the companies that have been able to do that for 60 years, companies like Philip Morris or Abbott Labs, Bristol, companies like Archer Daniels Midland, companies that are boring, insurance companies or food companies that are boring. The market doesn't get excited by them, so they stay relatively cheap. The CEOs make great decisions, and the shareholders have made 12, 13, 14% annually for decades, beating the S&P 500 by 100% almost. It's unbelievable, and it shouldn't exist, as I say, if you're subscribed to the efficient market theories. But if you understand emotions and economics, then you understand that this is the type of companies that Wealth Research will continue to cover going forward, because we believe that in the end, in 40 to 50 years, what matters most when you approach, or 20 years, when you approach your retirement, or 10 years, doesn't matter, is how well you're positioned with companies that have an enduring competitive advantage. Cyclical industries make short-term fortunes, and they come with great risks, but over the long term, nothing beats buying cheap companies at below intrinsic value and just compounding. And compounding means that you don't take those dividend distributions and spend them. you put them back into buying more shares. Now, think about this, David. It's like buying a property. The renter paying the rent, and you don't take that rent and spend it, but you actually buy more properties with it. So you're reinvesting your gains and let them compound over time. Now, in 20 years, when you've compounded enough, then you can say, okay, I'm going to take a percentage of these gains and actually spend them on lifestyle, and I'm going to stop working or something like that. And then you can fund a comfortable retirement, which is what I think people should do. The middle class in America and the lower class in America do not have any wealth. If they stop working, nothing comes in. And that is financial suicide. You need to make sure you make sacrifices over the years in order to have wealth, assets, when you need them in the future.
Yeah, I totally agree. So I understand that you're currently in Cancun. Is this business related?
Well, I'm actually in Playa del Carmen, which is one of the other booming towns next to Cancun, and I'm looking at real estate opportunities here because, for example, Playa del Carmen, it's Fifth Avenue, the storefronts. 15 years ago, it was about 3 blocks. Today, it goes on for about 40 blocks, David. And so I'm always looking for opportunities in real estate. Obviously, I'm going to the other beachfront towns here that have not seen this boom, and I'm looking for opportunities over there. But yeah, I go to about 10 countries a year to look at real estate opportunities and just opportunities in general, and understanding the sentiment and what people think about their economies. And it's something that just helps to stimulate my mind. And obviously, looking at businesses and stocks is something that you can do online. I'm sorry. So you don't need to be location dependent. So moving around helps to broaden my views in general. And yeah, so obviously, always a mixture between business and pleasure.
You're doing research on a whole other level, it sounds like, and that's great. And I definitely appreciate that. And finally, Lior, we're nearing the end of this cycle. Could you explain what investors should expect to see in the next 2 to 3 years? And are you currently seeing opportunities to take advantage of what's going on?
2008 was the biggest buying opportunity since 1987, and before that, since 1982, and before that, since the Great Depression, probably. So we're 10 years into a bull market. The opportunities that were there 10 years ago are not there today. But on the flip side, look at what hasn't risen for years. And I go back to risk. If you want to find opportunities in today's world, look at the cheapest sectors around. I talked to Jim Rogers a few days ago, Gerald Salente a few days ago, and I just watched a 7-hour clip of the shareholder meeting for Berkshire Hathaway's annual meeting with Buffett and Munger. I'll be there myself as a shareholder at a meeting next year, along with my partners. Look at what is cheap, unloved, disregarded, and go there. For me, the opportunity with commodities is the most obvious one. As you can see, the market is looking for further indication that commodities have entered a bull market because it's been in such a horrific bear market for so long. So we might have to wait for gold to hit 1,400 for speculative money to come in. But I want to get involved before the speculative money comes in, and I'm willing to wait. My patience level is high because I'm not betting the farm, and that is why I'm able to just diversify and allocate into commodities at the same time as I do other things. Now, some of these companies are so small, 50, 100, 150 million, that institutions cannot touch them, ever. And that is why sometimes these companies get to such low valuations, because there's no floor for them. And if you can become a master of that, if you can really become an expert, look at the amount of trades per day, look who's buying, look at the insider buying, and all of these important things that have to do with small cap opportunities, then you can make a fortune in relatively short time of a few years, instead of waiting for 30 to 40 years for the compounding effect to kick in. Remember that Warren Buffett made almost 80% of his wealth from the age of 60 and above. So it's important to understand that.
Yeah, absolutely. Wow. So I've learned a lot, as I always do whenever you come on Looking at the Markets. So much to think about, and I appreciate the insight into how you're positioning yourself, and how Wealth Research Group, how the team at Wealth Research Group thinks about investments and positioning themselves in these seemingly unpredictable markets. You're making sense of it time and again, and I really appreciate that. So once again, I'm going to put all those links in the description of this video below. People can click on those. They can go to wealthresearchgroup.com/Chile /bonds and /portfolio, and just check out the homepage over at wealthresearchgroup.com.
Yeah, thanks.
To get the newsletter and get the insights into the research, into what Lior is thinking at any given moment. I've been speaking with Lior Gantz. I hope to have you back on Looking at the Markets very frequently. I always get great feedback in the YouTube comments. Plenty of thumbs up, plenty of views, and plenty of new subscribers. So Lior Gantz, thank you so much once again. You're welcome back anytime on Looking at the Markets.
Thank you, David, and thanks for the listeners for taking the time and really educating themselves. If I can, I'd love for listeners to understand that investing is a profession, and like any profession, you got to study it. And I read about 2 books a month, and I just want to say that reading 2 books a month is not that big of a deal. In terms of the time allocation, even an hour a day gets you through 2 books a month, and I'd love for people to do that, to educate themselves, to understand that competitive forces are always at work, and you cannot think of life as your school years as, hey, I did my studying between 20 and 25 and I'm done. I'm now implementing. Continue learning all the time. Make life a school. And currently I'm reading 2 books. One is called The Most Important Thing Illuminated by billionaire hedge fund manager Howard Marks. Highly recommended. One of the best books I've read. And the other one is called Value Investing. And it was written in 2001 after the dot-com burst. So it's very appropriate for everything that's going on right now, and I highly recommend those 2 books.
I'll have to check those out for sure. All right, I've been speaking with Lior Gantz, wealthresearchgroup.com. Check it out, leave comments, click on those links below the video, and we'll have, hopefully, Lior Gantz back as a regular visitor here on Looking at the Markets. Thank you for your time, sir. I appreciate it, as always.
Thank you.